into section number 2. So everything else that we're going to talk about today can be summed up by one 2-word phrase: personal lines. Okay? We're going to talk about personal lines coverage. There's going to be a bunch of different policies we're going to talk about, mainly the homeowners, but we're also going to be talking about farm owners, we're going to be talking about dwelling, okay? We're going to be talking about mobile home. So we're going to go through all these personal lines coverages, but the biggest one that you're going to be tested on is the homeowner's policy. And the biggest thing you need to understand about homeowners is that it is a package policy, which means that it has to have 2 things in it. What are they? Property and liability. Right? That's a vocab term we just remember from our chapter 1, right? Package policies means that there's property and there's liability. Can I have either one of them endorsed off to help me save money? No. They have to be there, okay? It is a package policy. Now, the homeowner's policy that we're going to talk about, I have to stress this, may very well not look anything like yours, okay? But remember, this is the generic HO form that everyone's tested on. And I teach in absolutes, right? I say, you have to do this, or you have to make sure you do this. Only reason I do that is to help make it memorable, okay? So you know how your policy works, but remember, check that knowledge at the door and just kind of help me follow through the basic idea of how this homeowner's policy is built. So there are 2 sections. You got property and liability. Section 1, property. Section 2, liability. We're going to focus in on the property section first, though. And property under your homeowner's policy is divided up into 4 letters, and you have to know what each one of these letters signify. Okay? So we're going to break them down one by one. The first letter is A, and A is your dwelling. It's where you live. This is the house you're trying to insure. Okay? So A is your dwelling, and as we stated first thing this morning when we went through the pre-study, when I insure my home, I am insuring it with what kind of value? RCV, replacement cost value, right? RCV, and I have to carry at least how much percentage of my RCV? 80%. Nice job, okay? So let's just say, for argument's sake, I own a $100,000 home, okay? If I own a $100,000 home, how much insurance do I have to carry on it? $80,000. However, in this case, let's just say we're 100% insured. Okay, so if we're 100% insured, that means we're setting our home value and our limit at $100,000. In the event my home gets totaled by a tornado, how much do they pay out for my house? $100,000. Okay? So this is the most easiest one to understand, but you also have to know how important this is, because everything else that we insure underneath this homeowner's policy will have a direct reflection on how much we insure this for. It's all based off of a percentage of what we choose here. So if you underinsure your home, not only do you underinsure this, but you're underinsuring all the rest of your property as well. All right? So let's look at B. B is your other structures. These are other items, other buildings, other structures on your property that you want to insure that are not part of your home. Let me be clear. If it's an attached garage, if it's an attached shed, or if it's some kind of building addition that you put on, that's not part of B. That would be part of A, okay? If it's attached, that's all part of your dwelling. But if I've got a detached shed, a detached garage, a detached barn, that would be covered under other structures, okay? So I've got my home where I live, and I also have a 10 by 10 shed in my backyard. This would be covered by B, my other structures. But look at what happens here. Your limit will be based off of this. So it's not like this has its own limit that you can say, I want to be insured for $15,000 or $20,000 against my shed. They're like, whatever you insured here, whatever you chose here, we will give you 10% of it as your limit for your other structures. So if I had chosen to insure this property for $80,000, which I very well could have done, how much could I insure my shed for? $8,000, right? You impact everything else. So you start off with A, then you come down here to other structures, but you're given 10% of A. So these are any other structures that you want to have covered underneath your property. So for test purposes, understand though, your other structures are insured with RCV as well, okay? Ignore that ACV, other property. I have no idea what that's speaking to. It's not test relevant anyway. Just RCV on other structures, okay? We're all clear on that. A is your home, B is other structures, C is your contents. These are your things. This is your stuff, right? That's your property, right? That's your things. You need to insure those, and that's insured underneath your homeowner's policy. Okay? So that's how I remember what C is. It's your contents. Or if you're anything like me, I've got 3 kids underneath the age of 10, 90% of the stuff in my house is crap. So C, crap, contents, whatever you want to do. Thank you for getting that, Diane. Nobody else has a sense of humor. It's after lunch, though. I understand. There we go. Right, C, your stuff, okay? Now, this is anything you want to insure in a generic way, right? This is your bookshelves, your items in your house, your kitchen pots, pan, whatever. Anything that you wanted to insure as your stuff is insured underneath contents. Now, your contents 100% is on an ACV settlement. You cannot insure your contents with RCV. Well, Andrew, what if I have expensive items? What if I have a antique plate set? What if I have really nice baseball cards or furs or jewelry or silverware that I don't want to insure generically? Do I have an option?
Yes.
Absolutely. What do? Schedule that stuff out. Okay, so let's look at this endorsement here. So personal property can be endorsed to be underneath replacement cost. Because remember, most of your property is always going to be ACV unless your house or your building, okay? But my stuff can be insured with an RCV value if I schedule it on. Here's how it works. So it provides a specified limit for the property scheduled. See guys, if you schedule something out, right? That $30,000 plate set, I'm going to set its limit at how much? $30,000.
Yeah.
Why? Because if something happens to it, I want that replaced. If I had done that here, if I tried to cover that plate set here, would it have been replaced at $30,000? Heck no. Okay? That's the difference between RCV and ACV. So if I wanted to, I can schedule that out, but if I schedule it out, it's going to have its own limit. But if it has its own limit, it's also going to have its own what? You bet. Yeah. It's going to have its own premium. So your prices of your homeowner's policy are going to start going up and up and up the more and more you schedule items out. Okay? So we just try to give you some examples of things people have scheduled out. Valuables, furs, jewelry, silverware, coins, fine art, stamps, you name it. Right? Anything that's of value to you, can it be scheduled out? Yes, but it will have its own limit and it will have its own premium. But anything else that you want to insure underneath your generic idea of your stuff will be insured here. Now, this one was 10% of your home value. This is going to be 50% of your home value. So if I insured my home at $80,000, how much could I insure my stuff for? $40,000. Do you see how if you underinsure your house, you're actually kind of hurting yourself in other areas as well? Okay. So very, very clear on this right here. 50% of A, and remember how I said your stuff doesn't have to be in your house in order to be covered?
Right.
You could be halfway across the world. Guys, you could be on vacation using a really fancy video camera or whatever, and if it gets damaged or it gets stolen, you could actually file a claim under your homeowner's policy and still have it replaced. ACV value though, unless it's been scheduled on, okay? So there's only one time in which your personal property can't be covered. And it's not when it's in your house, and it's not when it's halfway across the world. It's when it's in transit. If it's in transit from one location to another, if it's in a truck, if it's in a car, if it's even on a plane, guys, that is when your property is in transit, and that can't be covered underneath your homeowners, okay? But any other time, it can be. We're going to talk about what your options are to cover items when they're in transit later on. All right, so you got your home, other structures, your contents, and the last part, the loss of use. What the other term we used to describe this was the indirect loss, right? If my home is damaged to the point where I can't live there anymore, and I have to live in a hotel, I have to eat out, I gotta use a laundromat, whatever, fill in the blank, whatever extra expenses you incur, can you also file a claim for those losses? Absolutely you can. Why? Because you're out of your house because of a covered loss. So if you're out of your house because of a covered loss, the insurance company will reimburse you for those charges, and they will reimburse you up to 30% of A. Neither one of these limits affects the other. Right? So let me just say this. Let me ask this open-ended question here for you real quick. If my home is destroyed by a covered peril, let's say a tornado, my shed is destroyed by that tornado, causing a total loss on all my contents, So much to the point that I'm out of my house for a full year, waiting for that thing to get rebuilt and get our lives back on track. What is the maximum amount the insurance company would have to pay out on that claim?
160.
Not 160. Would it pay all of that?
200.
Nope. Would it pay that on top of that? 110?
Yeah.
150, 160, and could it pay out a total of 30,000? Absolutely. Guys, on that, they could pay out 190,000. Just because you own a $100,000 home does not mean that's where they're going to stop. This limit doesn't affect this. This one doesn't affect this. This one doesn't affect this. That's why we call these additions. Do you see that term right there? That's why we call them additions. It's because one limit does not affect the other. Okay? But you have to be very clear about what A, B, and C, and D are underneath the homeowner's coverage. Okay? Because you're going to see those letters being used again and again and again. So you've got to know A is your dwelling, B is your other structure, C is your contents, D is your consequential losses or loss of use or indirect losses, whatever term you want to use. Okay? This is all describing how you're going to insure your property. Your buildings and your contents. Is everything covered underneath these four letters right here? Yes. Okay. For the most part, everything you can have covered up that you own is covered by one of these four letters right here. Other endorsements that you can add on to your policy: water backup and sump pump discharge or overflow. Let me be very clear. This is not flood. If you want flood, can you endorse that on? Yes. However, if your sump pump backs up, or you have any other water backup in your house that's not because of a flood, can that be covered by flood endorsement? No. You had to have endorsed this coverage on as well. Those are two separate coverages. So you had to endorse that on. Earthquake damage. Can I endorse that on? Absolutely I can. That's something we could add on, of course. But remember what some of the specifics were about that earthquake endorsement. How are the deductibles handled?
Per occurrence.
Well, yes, per occurrence, but per what?
Per
each structure,
yes.
Right? And it was based off of a percentage, not a financial amount, okay? So I've got to remember those specific things about the earthquake endorsement. Inflation guard, this is a key one. What if I had chosen to insure my home at 80%? So if I have an $80,000 limit on a $100,000 home, am I good? Yes. What happens when my property values go up, even if it's only by $1,000? What happens? If I only have $80,000 limit, what am I? Underinsured now, aren't I? Even though I maybe didn't mean to be, but if my property values go up and I'm still sitting at 80,000, I'm now underinsured. And could I be penalized for not having enough insurance on it? I could. Of course, the penalty's not going to be all that much, but still, I want to be covered for a full loss. So what do? I actually add on this endorsement. What is it going to do? It says, when my property values go up, they automatically increase my limit for me. See, it's my responsibility to maintain 80% until I buy that. Once I buy this, whose responsibility is it now? Insurance companies. Yeah, right? That's why I paid them the money to do that. It's because they now take advantage or take care of that for me. When they find out that my property values go up, they automatically increase my limit for me. Okay? There's one other endorsement that's very specific to the state of Kansas. And you have to know this. This is not one that you have to pay anything more for. But there are two characteristics that I told you were very specific to our state. And the very first one was, how many years did we have to sue in the state of Kansas? 5. In most states, it's not 5. Okay. And the insurance company has to pay losses within how many days from the date they agree to pay? 30. It's right here, guys. That's the special Kansas endorsement. So that's not something you're adding on, but it is something you do have to remember is specific to the state of Kansas. The rest of the endorsements down there are specific to liability insurance, so we'll get to those in a second. So we went over the basics of property insurance, A, B, C, and D. Now you need to know who is an insured under your homeowner's policies, okay? Knowing who is an insured, what the definition of an insured is vital to you passing this test, okay? You've got to know who's covered as an insured and who wouldn't be. Because now you have to know who's going to be covered under your homeowners and who would have been covered under liability, right? Because if it's something that happens to the insured, that has to be covered under your homeowner's property coverage. If it's something that happens to someone else, though, that would be covered under liability, okay? All right, so let's look at the definition of named insured. It's you and your spouse, as long as your spouse is a resident of the same household. See, if you and your spouse are living apart from each other, even though you're related, it doesn't matter. They are living, they are getting their mail in a different address, therefore they cannot be an insured. And definitely can't be a named insured. And here's why. If you want to know how someone is going to be decided if they're going to be an insured or not, you need to look at this next sentence right here. The insured is you and any residents of your household, which means they have to be living with you, right? That's what the term resident means. So they have to be living with you, who are your relatives. So if they are related to you by blood, adoption, or marriage, and they are living with you, that is how you determine if someone's an insured or not. See, when my father-in-law comes to visit, they just did this last weekend from Eudora, Kansas. They came down for a few days, and when they were staying with us, were they considered an insured?
No, because they have a different address.
Exactly.
No, because
They're
why?
not an insured when it comes to my homeowner's policy. Why? Because are they a relative? Yes. Are they living with me? No.
Oh.
So if something would have happened to them on my property, would my policy have paid for it?
Your liability.
My liability would have had to, right? My liability policy would have had to have paid.
What about a student exchange?
That's a great question. So any other kids or anyone students underneath the age of 21 who are in your care, like a foster child, foreign exchange student, or any wards of the state, yes, they are also considered an insured as well. Okay. So if they're under 21 and they're in your care, they're in your custody, right? We all used that terminology earlier. Then those are all considered to be an insured. So now you know who is an insured and who is not. It has everything to do with a two-word phrase, resident relative. If they are living with you and they're related to you, they are covered as an insured. If they are not, if they're living with you but they're not your relative, or if they're your relative and they're not living with you, that's not an insured. Okay? Also need to know where. The insured location, the residence premises, the part of other premises, other structures and grounds used by you as a resident, and is shown on your deck page. Of course, remember what the deck page is. It's personalizing your policy, so anything you have already listed there, or which is acquired by you during your policy period for use as your residence. Any part of a premises that's not owned by an insured, and where an insured is temporarily residing, so you don't have to own it in order to be covered at that location. Right? What they're saying is you could be living in or staying in a hotel, right? You could be staying in some place that you're just borrowing for a while. Vacant land other than farmland, owned by, rented to an insured, and individual family cemetery plots or burial vaults of an insured up to $5,000. These are places where you can insure. This is who is an insured, and this is what they agree to do for you. It's found inside the contract, and it describes the property that is covered by the limit of coverage scheduled on the deck page. So once again, what we're doing here is we're outlining property coverages. We're not hitting on liability yet, okay? Now, the homeowner's policy is an awesome policy. Why? Because you've got property, you've got liability. Everything's already done for you. But there are specific terms you have to meet in order to even buy one of these things. Okay, and you have to know who's eligible and who's not. The couple of different eligibility requirements start right here. The dwelling, A, right? What you're trying to insure underneath A, you have to be living there. See, landlords can't buy homeowners policies for the property that they rent to other people because they don't live there.
Right.
Okay? So they do have other options though, and we're going to go over what those options are here in just a little bit. But for test purposes, if you're going to get a homeowner's policy, you have to be living there, number one. Okay? Number two, has to be a 1 to a 4 family dwelling. Why can't I be anything more than that? Why can't I have 5 families living with me even if it's a large house? Because you're becoming dangerously close to the legal definition of what an apartment is. Okay? So it has to be between 1 to 4 families in order for it to still be qualified as a homeowner's plan. You can have up to 2 roomers or boarders who are living with you, but they aren't related to you. However, their property isn't covered here. Why? Because someone who is living with you, who's not related to you, is also not a what?
Relative.
Not an insured.
Insured. Okay.
And if they're not an insured, will their personal property be covered underneath my homeowners?
No.
Nope. Their property is not covered because I have no insurable interest in it. Farms and businesses aren't eligible. You're using your home and you have a farm on your property. You cannot get homeowners policies. You've got to get farm owners policies. If you're going to run a big business out of your home, you can't get a homeowners policy. You've got to get a business owners unless the business you're running out of your home can be defined as an incidental service business. Because see, a lot of times people who run businesses out of their home, they don't have like a lot of employees. It's not a big mercantile or manufacturing type of business. It's just, you know, someone wants to own a beauty shop or a barber shop or give musical lessons or have a photography studio inside of their home. Those are all just, or someone who even is like a salesman and they just want to kind of operate out of their home instead of renting a building, right? All of those businesses, can they be operated outside the home, or inside the home, excuse me? Yes, but you can still be qualified to have homeowners coverage on that. All right, so 2 or less employees, well, you have to kind of remember there, that's what an incidental service business is. But there are a couple key things though that you cannot do. Number 1, you can't run a mercantile business out of your home, even if you only have 1 or 2 employees. What does that mean? That means that you can't sell a ton of product. Now I'm not talking about people who run like jewelry, you know, or Tupperware, or, you know, 31 or all that kind of stuff. I'm not talking about that. What I am talking about though is running like a retail store out of your home. If you do that, your homeowner's policy will be, or your insurance company will be like, you can't get homeowners. You need a business owner's policy now at this point. That's a mercantile business. You also can't manufacture products out of your home. If you're manufacturing products, they're going to tell you, you can't be eligible for one of these plans. Okay? What you're going to have to do is you're going to have to go get a business owner's coverage. It's a lot different. We'll talk about those tomorrow. But I want to make sure you understand, we're talking about eligibility requirements to get into these homeowners policies. Can't have a mercantile manufacturer business, can't be a wholesale distributor, which means carrying a bulk load of product. Once again, I'm not singling out the people who do this, you know, jewelry or 31 or anything like that, but you're using your entire shed to store a ton of product so it can be distributed. No, they're not going to let you do that either, okay? And of course, if you're running an auto repair shop out of your home as well. Those are all ways to not be eligible for an HO policy. Now, sometimes when people have businesses and they're running them out of their home, sometimes they're not running them out of their home per se. What are they doing? They're running them out of their garage, their shed, their barn, whatever. And the homeowner's policy says, okay, that's all fine and good. We'll still cover the dwelling. We'll still cover the contents. We just won't cover the other structure. What they're saying is you can limit that. You can exclude that from your coverage, okay? And you can get this covered underneath the business owners or something like that. There's actually only one way in which you can get money off of coverage B, or out of your other structure, and still actually be qualified, and that is if you rent it to somebody to store their car, their boat, their motorcycle, okay? If you're just renting it to someone so they can store it, the insurance company says, yeah, that's still fine. You don't have to, that's not gonna exclude you from coverage. The structure's covered, obviously the property underneath it's not, because you don't have insurable interest in it, but, okay? So that's what coverage, when coverage B, you can make money off of your shed, but you aren't going to be excluded. Unrelated tenants' personal property and liability are not covered. We already went over why though. Because if they are not related to me, even though they're living with me, they can't get their own stuff covered. Why? Because they're not an insured. They will actually need their own coverage, and we're going to go over what that coverage is here on the next page. But a resident relative, someone who does live with me and is related to me, is their personal property covered? Of course it is, because they are also a what?
Insured.
An insured. Okay. Now before we move forward, it's absolutely imperative that we remember 2 very important things. We need to remind ourselves what the letters are and what our coverage forms are when it comes to property. Okay, so the first letter that I introduced you to was A, right?
Yeah.
A covers your what?
Dwelling.
Dwelling, your home. What does A look like? Kind of looks like a house.
Yeah.
Okay? If I have B, an example of B, other structure would be a detached barn, shed, garage. Okay? And when I insure my contents, 90% of the time they're found inside my home, right? And then if I need any compensation for the fact that I'm out of my house and I've got to go out to eat, where am I going to go out to eat? Dairy Queen. Or Denny's. Fill in the blank. Or your favorite D restaurant. Okay? So dwelling, other structures, contents, And of course, loss of use, indirect loss, right? Those are what those are going to be covered by. Your other structure, what was the percentage? You remember? 10%. 10% additional. What about your contents? What was it?
50,
You got it. And your loss of use?
30.
30%. Nice job, guys. All right. The next thing that we need to review then is our coverage forms. And this is jumping all the way back to the beginning of chapter number 1. There were 3 different ways we could cover our property. And that was by choosing one of these 3 forms. The basic, broad, and the special. The basic and the broad forms were known as named what? Peril policies, right? These were the named peril policies. The perils had to be named in order for them to be covered. Remember what basic was? It was just fire plus wharves, right? And then broad, you took everything covered underneath basic and added in a few more named perils. But in order for them to be covered, they had to be named. Those were more restrictive. The special one, though, was the named what? Exclusion. Which means that all losses, all perils are covered unless it happened as the result of a named exclusion. And then therefore it wouldn't be covered. Okay? Any questions over those 2 things? We already hit on both of those. I just wanted to review that before we went on. Because now what we're going to do, guys, is we're going to talk about the 6 homeowners policies that you might see a test question over. And yes, I did say 6, but I'm going to make sure we break them down in very simplistic ways to help you remember them, okay? In fact, as you look at your content outline, these are the very first 6 items that show up on your content outline if you download it from Pearson VUE, okay? So you will see test questions over them, I can guarantee you, but I don't want you to be overwhelmed by this. This is the section of the day, though, where people start giving me that, like, oh crap, what did I just do look? Okay?
They're all over the test.
What's that?
It's all over the test.
It is. It truly is. So you just have to know, okay? All right, so we're going to break them down. The easiest one, in my opinion, to remember is the HO2. Okay, we call it the broad form. Why do we call it the broad form? Because look at how it's worded there in that box. If anything happened to my dwelling, if anything happened to my other structure, or if anything happened to my contents, it had to have happened as the result of a broad named peril. If it didn't, would it have been covered? No. Okay? So the HO2 is one of the more restrictive policies out there, though, isn't it? Right? More restrictive, which also means, though, it's probably going to be one of the more cheaper ones as well. Okay? But that's the first one we're going to go over. It's called the HO2. We call it the broad form. A, B, and C are all covered underneath the broad form. The HO3 is the one that kind of screws it up for everyone because it divides it up. But this is the only one that splits. So if you get any question about that's ones that's going to split the coverage forms, it's going to be the HO3. Because look at what happens now. We call this the special form because look what happens. Special cause of loss now on your dwelling and your other structure. So if anything happened to your home or if anything happened to your other structure, did it have to happen as a result of a named peril? Not here. As long as it didn't happen as a result of a named what? Exclusion, right? So this is so much better than HO2. Because remember, under HO2, if anything happened to my home, my contents, or my other structure, it had to have happened as a result of a named peril. But now we're not getting that intense. So now if anything happened to my other structure, or my dwelling, then it had to have happened as the result of a named exclusion in order for it not to be covered.
So it covers everything but the exclusion.
Yeah, right? But your content, though, doesn't actually cover that under special form. If anything happens to your stuff, it still had to happen as a result of a named peril under the broad form. Yeah, I know, this is the one that just starts ticking people off. They're like, why can't they just leave them under the same? I know. Okay? But if you need any kind of solace in this, any kind of comfort at all, the HO3 literally is the only one that does this, that splits it up between 2 coverage forms, okay? So if you get one that says it's got 2 different coverages, it's got both broad and special, then you know it's the HO3 without any problem whatsoever. And then it gets a little bit easier. We're going to go down to the HO5. The HO5 is called the comprehensive form. Why? Because what we're doing now is we're bringing everything back together underneath one umbrella only now. Instead of everything being underneath the broad coverage, We're bringing everything underneath the special. Okay. So now if anything happened to my home, anything happened to my other structures, or anything happened to my contents underneath the HO5, if it didn't happen as a result of one of these named exclusions, we're good. This is the most common of all the generic forms out there, the HO5, but it's also the most expensive because you take on less risk there. You're asking the insurance company to take on more. So the 2, the 3, and the 5 are the more simpler home policies, right? Those are ones when people are just buying a home. These are how we're going to insure our dwelling, our other structures, and our contents. But there's 3 more, but each one of these kind of brings their own little special characteristic to them. So that's why I wanted to hit on these first, okay? And this is just a real quick note. If you don't remember what basic, broad, and special are, it tells you, right? It tells you what page to go back and look at, okay? But the next one I want to talk about is the HO4. Now we call it the HO4 the renter's form. Why do we call it the renter's form? Because this is the form that people are gonna buy when they don't need coverage for their dwelling or other structures. Think about this. If I'm renting someone's home, or I'm even renting an apartment, do I own that home?
No.
Do I own that apartment?
No.
No, so do I need coverage for it?
No.
Not in the least. What about other structures? What about other detached sheds, barns, garages?
No.
Am I responsible for that?
No.
Of course not. I don't have insurable interest in it anyway. So why in the world would I buy a policy that's going to cover me from that crap? I don't need it. But what do I need coverage for? My contents, right? So C is the only thing that's covered under the HO4. You don't have A, you don't have B. All you have is C, contents. And we also need to know that the HO4 is a contents broad form. So if anything happens to your contents underneath the HO4, it had to have happened as the result of a named peril. Okay? That's why we call it the contents broad form. That's all that matters here, is your stuff. Doesn't matter about the dwelling, doesn't matter about the other structures. You don't own that stuff anyway. Okay? That's why we call it the renter's form. Remember how I said unrelated tenants' property aren't covered and they needed a policy on their own? That's what your unrelated tenants are gonna need. They're gonna need to buy an HO4 to cover their stuff, because you can't cover that underneath yours, okay? The next one we need to go over is the HO6. The HO6, quite simply, guys, is called the condominium form. Why do we call it the condominium form? Because when you own a condominium, do you need to protect the inside, the inner shell of your condo? Do you own that? Do you have insurable interest in that?
Yes.
Yes. So are you going to have coverage on A? Yes, but it's not going to be anywhere near as bad as if you had to cover the outer shell either, right? So A, yes, but it's going to be a minimal A. What about other structures? If there's other structures on the condo property, are you responsible for those? No. So you don't need it. But what do you need coverage for? Your contents. Okay? So your contents are huge here again. So not only do you need to cover the inner shell of your condo, but you need to cover your contents. And underneath the HO6, where you have coverage on A and C, it's once again broad named peril coverage. Okay? Do you understand why we spent so much time breaking down broad earlier?
Mm-hmm.
Because see, none of this would have had any kind of connotation had we started with this. Okay? Do I wish that I could find a different way to introduce this instead of right after lunch on day 1? Yes, I do. But I have to give you this background knowledge first, okay? All right, so we went over the 2, the 3, the 5, and then the 4 and the 6. The last one we need to go over is the HO8. Right now, for test purposes, the HO8 is the one that we use for older homes. We also call this the modified form because look at this. We can't call this the basic form even though it's the only one that deals with the basic named perils, okay? So we call it the modified form because under older home, we're gonna cover it for basic named perils and add in one peril, vandalism and malicious mischief. Why? Because older homes are much more susceptible to that kind of damage. So under an HO8, you'll be covered for any named perils underneath basic plus vandalism and malicious mischief. But it is by far, out of all 6 of these, the worst coverage that you can get, and it's also the cheapest. Why? Because look at what happens here, guys. For your dwelling, for your other structures and your contents, you are only insuring it up to what value? Nope. What am I looking at?
Market value.
ACV. Actual cash value. Guys, if you insure a home for ACV, are you expecting a home back?
No.
What are you expecting? Check.
Yeah.
Right? That's what you're expecting, and it's not even going to be that good of a one either. Okay? And we also said underneath older homes, they may not even do ACV. They may only do it up to the market value as well. Okay? Remember what market value is, that's how much they're willing to sell that property for. Okay? So there's 6 different forms here, guys, but I really tried to take my time walking through the difference between all 3. I don't want you to be overwhelmed by this. I really, really don't. You can be. It's very easy to be. But if you kind of just look at how each one of them are broke down and you compare it up against this chart right here, if you haven't written this down, I probably would if I were you. We're also going to go through a review of this here in just a little bit. But if you can look at all 6 of these perils, or these forms, excuse me, and look and compare them up against this chart, then hopefully it helps them all make sense. Yes, ma'am?
I was gonna tell you, when you brought up like the syllables, that helped me a lot.
Did it really?
So
Okay.
I don't know if that'll help everyone else.
What Jessica's talking about is I used to have a different way I used to introduce these. And if she brought it up, then I'll be happy to tell you. So if you are a tangible learner, sometimes people are much better with their hands than they are instead of listening. So there's actually a more tangible way you can know these as well. This isn't my tactic, I can't take credit for it, but it did help. Okay, let's look at the first one. It's called HO2, called the broad form, right? Remember why it's broad form? Because A, B, and C are all covered underneath the broad name perils, right? How many syllables are in broad form? Broad form, HO2. The special form. Why do we call it special? Because now we're going to add in special coverage for my dwelling and my other structures, but I can't add it in for contents yet. But we still call it the special form. How many syllables in special form?
3.
HO3. We call the HO5 the comprehensive form. Why do we call it comprehensive? Because we're bringing everything back, right? We're putting it all back underneath the same umbrella. Comprehensive form, A, B, and C, all now covered underneath a special form, but we now call it special form, we call it comprehensive. How many syllables in comprehensive form?
5.
Comprehensive form, HO5. Jumping down to the renter's form. 2 different ways we can think about this one. How many letters are in the word rent? 4, R-E-N-T, sometimes people remember it that way. Or remember another way I told you I wanted you to remember this is contents broad form, right? Because all that matters is your contents. Not the dwelling, not the other structures, you don't own that stuff anyway, but contents broad form. How many syllables?
1.
HO4. The condominium form, right? Condominium form, why? Because you're only covering the inner shell of your condo. You don't need the outer shell. You don't need other structures, and your contents your contents are still covered underneath the broad name perils. How many syllables in condominium form? Condominium form, HO6. And then the last one, this is the stretch. No rolling of eyes, please. Older home, we call this the older home form, right? Because this one is designed for older homes, but we also call it the modified form because we can't say it's basic, right? If it was basic, we couldn't add in vandalism and malicious mischief. So we call it the modified form, okay? But A, B, and C on an ACV basis only, it's a terrible coverage, but at least it's something. Something's better than nothing. But under the HO8, we call it the older home and modified form. How many syllables? Older home and modified form. HO8. Shut up. Find something better. No, I'm kidding. I'm
That's
kidding.
good.
Okay? So if that helps, awesome. I used to do that about a year ago, and someone's like, that didn't help me at all. And I'm like, oh, okay. So I kind of took it away because it didn't seem like it helped. But if Jessica, if that helped you, then I'm happy to go through that. Okay?
Did me.
Okay, awesome. I'm glad it'll work. All right, so now underneath all 6 of these homeowners forms, there are 2 things that are true of both of them, and you have to know them, okay? If you buy an HO2, an HO3, an HO4, an HO5, an HO6, or an HO8, they have 2 of the same coverages. Number 1 is theft. It covers theft of all personal property. I don't care which one you got. Because as you're looking at all 6 of these forms, what's one thing that's similar in all 6 that covers your
Content.
So they all have theft coverage. The other thing they all have is liability. Why? Because homeowners forms are package policies, and this is describing how you're covering your property, not your liability. We're going to go over liability here in just a little bit. Section 2 is different than Section 1, guys. Section 1 only has to do with your property. Now, we could spend some time breaking down this list, but I'm not going to because I spent a ton of time breaking down exclusions in Chapter 1. If you see anything in here you have any question on, you can ask. But guys, I'm telling you, you've seen one exclusion, you've seen them all, okay? You won't find anything in this list we haven't already gone over. Anything that's in this list is a reason why they won't cover a claim, even if you have special coverage, unless you're talking about these right here, earth movement or flood. These can be endorsed on, but remember, if you endorse them on, they're gonna cost you extra money, okay? A couple other things I wanna address before I send you on your next break, which I know we're all ready for. There's 3 things on this list that we need to break down. The first thing is this top part here. We call these inside limits. Why do we call them inside limits? Because on every single insurance contract, any of these homeowners contracts, if you are insuring stuff under coverage C, remember it all has to fall underneath one generic limit, doesn't it? Right? So remember, if I own my $100,000 home, I only have $50,000 that I can use to insure or cover all of my stuff. If I have even a few items of value here, won't that limit get hit pretty quick? It can, which is why they want us to be scheduling stuff out. But let's just say that we don't, okay? Let's just say we have furs, jewelry, precious stones, watches that we didn't schedule out. But I've got a receipt that tells them how much they're worth. Say they're 10 grand, okay? And I go to my insurance company, I'm like, yeah, I know I've got this $50,000 limit. However, you know, this one watch, it's been in my family forever, it's been appraised at $10,000. Did you schedule it out? No. Okay. And what happened to it? It was stolen. Oh, it was? I'm sorry to hear that. Here's your $1,500 check.
Yeah.
See, that's why we call these inside limits, because these are going to be true not only of your contract, but of every single contract you come into contact with on this test, okay? So all of these inside limits are not specific only to you. Remember how I said most limits show up on your deck page? Not here. These show up in the policy, okay? So if I have any of these losses, if it was stolen, misplaced, or lost, underneath any of these categories, it didn't matter how many, didn't matter what I can prove, the insurance company says, sorry, this is all we have to pay. Guns. I could go to them with a receipt saying I paid this $3,500, $4,500 for this one gun. And if that one gun got stolen, misplaced, or lost, they'd say, sorry about your loss, Mr. Kemper. Here's your $2,500 check. Why do they set these inside limits? If I've got property of value, what are they probably trying to encourage me to do here? Schedule that stuff out. Don't leave it up to chance, because also remember, they're only giving you ACV underneath this. They're not giving you RCV. Okay? Look at this one, pewterware, goldware, silverware. Any of those are stolen, misplaced, or lost. Once again, $2,500. This next one is the one that scares me. Banknotes, gold, silver, and money. Cold, hard cash. You could take a picture of 10 grand sitting underneath your mattress the night before your house catches on fire. If it were to go up in flames and you tried to prove to the insurance company you had 10 grand underneath your mattress, you know how much they'd give you? Here's your $200 check, Mr. Kemper. Thank you, have a nice day. Right, so that grandfather of yours that told you to put your money under your mattress because it was a better option than a bank, lied to you. Because unless you scheduled money out, which you can do, but boy is that expensive. Unless you schedule that money out, you try to cover that underneath your coverage C, right, your generic contents coverage, you won't get nothing back. Right, couple others, recreation of personal records, or recreation, excuse me, of personal records, securities, accounts, deeds, passports, evidence of debt, manuscripts, tickets, right, stamps, watercraft trailers, and motors. Any of those items, you could prove this is how much I spent on every single one of them. The insurance company's like, yep, sorry, here's your $1,500. Okay, they're wanting you to schedule stuff out, guys. $2,500 for property primarily used for your business. Remember how I said you could run one of these businesses out of your home? Photography studios? Think about that. How much does camera equipment cost? thousands and thousands of dollars. And if you run your photography studio out of your home and you don't schedule that property out and you want to be covered for losses caused by that, the insurance company's like, yep, sorry about those losses, here's your $2,500 check. Man. Portable electronic equipment. While in or upon a motor vehicle, away from residence premises, if it can be powered by both the vehicle and other power source. This tells you how old this class is because we're using words like tapes. Not even sure we use that word anymore. Common language. Wires, records, discs, and other media. So these are inside limits, guys. These are inside limits that you have to understand are going to be attributable to every single contract. Remember how I said limits more often than not show up on the deck page unless it's these. Okay. This little middle box right here, this is just review. Right? These are exclusions. These are reasons why insurance companies will not cover claims, right? Underneath coverage A and B, remember what I told you, was one of the most generic type of exclusions you'll ever run into, and that's land, right? The land that this is built on, you can never insure. I can insure this, I can insure this, I can't insure the land though, right? I can insure the property that's built on top of the land, I just can't insure the land itself. And then underneath coverage C, unscheduled personal property. If you schedule property out, you can't be covered underneath both, right? That's double indemnity, and of course they won't let you to do that. Aircraft, you can't cover as part of your contents. We already said you need aircraft insurance anyway. Motor vehicles, except those used to service a residence and assist a handicap. Damage to animals, birds, and fish. Unrelated tenants' property, and business data. All right, so these were all exclusions. If you want to put the word exclusion there, just help you remember what these are. But the last section I want to hit on real quick, before I get you your break, is this term additional coverage. And to understand what an additional coverage is, we've got to understand that damages that could happen as the result of a covered peril aren't always going to be limited to my dwelling, my other structure, my contents, or the loss of use of my house. Right? I mean, as you start looking through this list, debris removal, right? If debris is on your property because of a covered loss, right? Because of the tornado or whatever, you're still responsible to get that debris picked up, right? That's still part of that your responsibility in order to get your property back up in a good shape. So will your insurance company help you cover that? They will. Will they pay for reasonable repairs? Yeah. Will they pay for damages to your trees, shrubs, and other plants? They can. Will they pay for service charges? Will they pay for property removed to preserve the property? Will they pay if your credit cards get stolen? Will they pay if there's been a collapse or landlord's furnishings or glass? Guys, everything that's in this list right here will not fall underneath A, B, C, or D. Okay? But these are all additional coverages, which means that the insurance company, yes, will pay for these losses as well. All right? But there's two different ways in which they will. If it's an addition, remember these right here. This is an addition. This is an addition. This is an addition. It does not affect this limit right here, right? It pays on top of it. So at no point, even though I'm only insuring this for $100,000, if this has a loss, whatever damage happens here won't affect this limit, okay? That's only for it. That's if it's an addition. Guys, if something is listed as an extension, I know it sounds kind of similar and has very similar kind of connotation to addition, but it doesn't here. If it's listed as an extension, look what happens. It does not increase the limit, but instead it allows the insured to apply unused limit from coverage to another, which is always going to happen underneath coverage A. Let me explain how this works. Look at debris removal right here. This is an extension of coverage. I'm not going to read this next part here quite yet. This is an extension of coverage. What does it mean? It means that it will pay for $500 per tree, up to a maximum of $1,000 for removal of my trees felled by wind, hail, ice, and a neighbor's tree felled by a covered peril, provided that it damaged a covered structure. What that's now saying is, as the result of this storm, right, I've got debris on my grounds, right, and I need to get that picked up. Whatever it cost me to get the debris up off of my property, and whatever damage happens to my home, it doesn't matter how much this is plus this, the insurance company will not cut you a check larger than that amount right there. See, this now affects this limit. Does that make sense? That's what an extension is. So it doesn't matter if you use 10 grand here and you have a total loss. Can you get covered? Can you get reimbursed for the debris? No, you can't. Not in that case. Okay? So do you understand now what an extension is? It affects the limit. Additions don't. Okay? So once again, we come back over here then. So it's an extension of coverage. However, it's an additional 5% of A if your loss plus the debris removal exceeds the policy limit. Oh, so that's good news now. So in that event that I just told you, if that actually did happen, that actually turned into an addition and they would give me 5% more. 5,000 is a lot better than nothing, right? Okay, so can I use that 5,000 though toward only just one tree? No, because there's one of these other drastic inside limits right there. It says it's only gonna pay 500 per tree. Oh, thanks a lot, right? Got a tree in my yard that's probably 3 times older than I am. $500 ain't gonna do nothing to replace that thing. But at least something's better than nothing, okay? So that's once again what we're talking about, is that little inside limit right here. It won't pay anything more than that. Up to a maximum of $1,000 for removal of your tree. Once again, felled by wind, hail, ice, and a neighbor's tree felled by a covered peril. Another extension is reasonable repair. To understand what reasonable repair is, we have to remind ourselves what is our duty when a loss happens. Remember, there were 3 different steps. The first one was we have to do what? Report it. Notification, right? We notify the insurance company, or we notify who if it's a crime?
The police.
The police. What was the second step?
Take action.
What's that?
Take action so nothing else is damaged.
Preserve that property from further loss. When you do that, are you going to incur a little bit of an extra expense probably to do that?
Yeah.
Yeah. That's what a reasonable repair is, guys. Any type of temporary repair, anything that you do in order to preserve property from further loss, anything that you do that's not meant to be long term, it's just so you can get something until we can actually get an actual repairman out there. Those are extensions. What does that mean? That means if you do some temporary repair to your home, but then your home gets totaled out by the storm anyway, can you get covered for those losses for the reasonable repair?
No.
Because remember, the insurance company won't cut you anything larger than a check than that. Okay? That's what an extension is. We don't have a lot of extensions, guys. We really don't. Most of these are additions. But you got to be clear on what the difference is. Trees, shrubs, and other plants. There's an addition. 5% of A, so $5,000 in this case. Maximum, though, blasted. $500 per item again. Right? So it's like, yeah, you've got this $5,000 limit, but use $500 per tree, shrub, and plant. Okay? So landscaping damage could be covered if it's the damage because of fire, lightning, explosion, riot, civil commotion, aircraft, non-owned vehicles, vandalism, or malicious mischief. But, much to the chagrin of people here in Kansas, it does not cover for losses caused by wind, hail, ice, or snow. Dadgummit. Got a tree in my backyard that would have something to say about that. It now splits off like this, kid you not, but anyway. Okay, so once again, can landscaping be covered? Yes, but it can't be covered for these perils right here. Fire department service charge. In order to understand what a service charge is from a fire department, this is when you're using a volunteer fire department, okay? So communities that have to use volunteer fire departments, how do those fire departments get reimbursed for their work? It's not by the city, right? Because they don't work for the city.
By whoever house they go to.
Yeah, they bill them, right? They send them a bill in the mail that says, yeah, this is how much we actually have to charge you now. That's called a service charge. The insurance company, though, says, yeah, we'll help you cover some of that as well, right? That's an additional amount, and it could pay up to $500, and there would be no deductible there. Is that A, B, C, or D? A fire department service charge? No. But still, was it caught? If my home catches on fire, is that a covered peril? Of course it is.
Yeah.
So this would be covered now. Okay. Little humorous story. I was actually teaching this class one time, and I asked that open-ended question: how are volunteer fire departments paid? And without missing a beat, girl in the back of the class said, "Beer." Okay. Maybe in your community. Good to know.
Not on the test.
Right, yeah, not on the test. All right, number 5, property removed to preserve the property. Extends coverage to property removed for 30 days against direct loss from any cause. Now, that might look a little mundane, but I want you to underline that word, any cause. And I want to tell you this story. It's absolutely true. The gentleman who I actually trained from, he sold property insurance for a while. Sold homeowner's policy to this woman who her home caught on fire. And because it caught on fire, they had to get all the rest of her property that didn't burn, and they had to move it into a storage shed, okay? So what did they do? They removed the property to preserve it, right? They couldn't leave it in the home. There's no way. But why is the property inside the storage shed? It's because of the covered peril, right? We're all clear on that. So a week later, that storage shed suffered loss because of a flood, and all the rest of her stuff was completely lost. Did she have flood insurance?
Probably not.
No. Did the insurance company have to cover that? They did, because that is called an additional charge. Even though she did have flood insurance, it didn't matter. Why was the property there to begin with? It was because of a covered peril. Read it again, now that this is in your mind. Okay, it extends coverage to your property removed for how long? 30 days against direct losses from what kind of cause?
Oh,
Now does any cause have a little bit more bearing?
yeah.
Any cause. Flood damage, earthquake damage, war, every single exclusion that we've been using all for the last day, guys, it doesn't matter. The insurance company would have to cover that. For only 30 days though. It's not like it's a year, right? It's 30 days. Why? Because they're hoping they can get it moved to a more secure location at some point. Okay? Credit card, fund transfer card, forgery and counterfeit money. That's an extension, which means it still won't pay anything more than this. But if someone steals your identity, they're only going to cover you for up to $500, which is why having some kind of identity theft coverage is probably a better idea than using your homeowners, but at least they'll cover you for something. Loss assessment. Loss assessment is used when you're part of an HOA. Okay? Now, not always, but this is how I've never been part of one, but this is how I've been told HOAs work. If you're part of a homeowners association, not only do you own your home, but you actually take part ownership in everything else that's communally used, like clubhouses, golf courses, swimming pools, parks, you name it. Everyone within the HOA has a partial ownership to that property as well. So if something were to happen, let's say the clubhouse is damaged, here's what the insurance company does. They come in and they actually assess that damage, and they say, okay, they had $67,000 worth in damage. Okay, here's your portion, here's your portion, here's your portion, right? They divide out the loss over every single person in the HOA. Is that describing losses to your A, B, C, or D?
No.
It's not. But insurance company says, we will help you cover for that as well. Okay, that's what loss assessment is. Now, $1,000 is the minimum that they could cover you for, which isn't bad. But I've actually heard in rare cases, loss assessment can be actually granted or endorsed, endorsed to be as high as $40,000 each. That's of course if you're living in one of those Andover neighborhoods, right? Okay, but that's what loss assessment is talking about. Okay, property that you kind of have partial ownership in, but it's not part of A, B, C, or D. Collapse. Collapse is not a covered peril. Please underline that sentence. Collapse is not a covered peril. Unless the collapse was caused by a covered peril. Do you remember how we talked about some of those things that we described as exclusions? One of them being decay, one of them being wear and tear, one of them being wood rotting. Do you have any type of control over that stuff happening? No. So collapse is not going to be a covered peril unless the collapse was caused by a covered peril. So if a windstorm comes along and causes my deck to collapse, right? That's what we're talking about here. If something happened as a result of a covered peril, could that be covered? Now, yes, it can. Okay? Any damage caused because it collapsed would be covered, but it's not going to be covered from like insect damage, decay, weight of people, weight of property, any of this stuff, guys. These are all exclusions. Okay? But hopefully it makes sense why, because of course you have all control over that. Landlord's furnishings. If I'm a landlord, I can insure my property as an additional coverage. Instead of adding it on to my homeowner's policy, I'll have another option of doing that here in a second. And glass. Remember how I said glass can never be insured underneath ACV? It would make no sense anyway. Okay. Replacement cost value, RCV. So that's just more of a review from earlier as well. Guys, that's a lot of material to take in. I'm sorry, I wish, like I said, it didn't have to happen right after lunch. But we're making good time, actually. We got through that section in good time. Does anyone have any questions?
I do.
Yes.
Are all of these that we have to pick and choose them, or do they just naturally come with the
Naturally.
policy?
For
Okay.
test purposes, all of these are included. Even though it's not A, B, C, or D, it doesn't matter. Remember, that's why we use the term additional coverages. They are gonna pay on top of, unless it's one of these few that are an extension here. Okay? It's a great question, though. Thanks, Tim.